Well, thank you guys. It's delightful to be at the Humphrey School, and as somebody who covered the last 8 or 9 presidential elections, I was, that's code for he's old enough to have been around and remembering Hubert Humphrey, who was an incredible political figure for a very long time. I also feel some sense of kinship being in a room named for Walter Heller, because I, as a kid who grew up in Washington inside the Beltway, I went to school with the son of Heller's successor as chairman of the Council of Economic Advisors, Paul McCracken, and I have vivid memories of young Paul in the basement with a blacklight poster and his band playing for parties, doing a little Jimi Hendrix, the best Jimi Hendrix he could do back in that time. I'm delighted we have a full house. When I walked out and saw everybody filling the seats, I was thinking that perhaps you were expecting a Bernie Sanders rally tonight. And in fact, we have the Federal Reserve's version of Bernie Sanders right here in Neel Kashkari. Let me just, to take the temperature of the room, start by asking, raise your hand if you are for Bernie Sanders in this campaign. Raise your hand if you're for Hillary Clinton. Raise your hand if you're for Donald Trump. A few. Okay. So we have a lean to our audience. Neel, let me start with asking you about Sanders, because when you began attracting publicity for your too big to fail inquiry and initiative, you became cited in the way of even Republican Bush administration veteran Neel Kashkari supports what Bernie Sanders wants to do, which is breaking up the banks. Talk about where you think Sanders is right and where you are not quite there in terms, he says we know enough right now to break up the banks, and he'll do it in his first year as president. Your position's different. Explain.
So my position is based on my experience during the financial crisis. So just to be direct, I'm the guy who bailed out the banks. So I know something about bailouts. We hated that we had to do it. We were in this terrible crisis. It was the right thing to do. We never want to do it again. And so combining my experience with all the expertise at the Minneapolis Fed and here at the Econ Department, we're looking at what are all the options to address too big to fail so we never have to do it again. So we've launched this initiative. Today we had a symposium, our second symposium, where we're analyzing all of the transformational options. One transformational option is break up the banks. It's not the only one. Another transformational option is you put so much capital in banks that you treat them like utilities so they virtually can't fail. Another one is you tax debt. There are a range of transformational options that I think need to be given serious consideration. We're considering them. And all of this is going to come together at the end of the year. We at the Minneapolis Fed will release our recommendation for the optimal way to address the problem of too big to fail banks. So we haven't decided what the solution is yet. We're considering all of them. One of them is breaking them up, but it's not the only one.
Mm-hmm. Now, because you spoke so fast, no one had a chance to boo after you said you had bailed out the bank. So does anybody want to take that opportunity now? Okay. Because I've heard a lot of voters say, hey, Wall Street got their bailout. Where was my bailout?
Look, trust me, I understand that. And I ran for office. My calling card running for office was, hey, I'm the guy who bailed out the banks, vote for me, right? And so I heard that a lot from voters when I ran for governor of California. And I understand that anger, and that anger is well justified. Because, we as Americans have certain beliefs that have been passed down from generation to generation. If you take a risk, you bear the consequences and the rewards of that risk. Well, we had to violate that core tenet of what it means to be an American when we bailed out the banks and we stabilized the financial system. And when you violate the core principles of a society, it leads to great anger. And I believe the anger on both sides of the aisle today can be tied back to those decisions in 2008. So I understand the anger. But effectively, the US economy had a massive heart attack in 2008. And we had a choice. We could let the market work in which case the heart attack would kill the patient and we'd be in the Great Depression, or we could do a massive intervention to stabilize the heart attack. And that's what we did using taxpayer resources. It was the right thing to do, but it's nothing we ever wanted to do or ever want to do again.
Taxpayer applied mouth to mouth.
Taxpayer applied intervention right in the heart. I mean, even more directly, the financial system is like the arteries and the heart of the human body. And so because the financial system was having that heart attack, we were literally facing a Great Depression scenario if we failed. And that's why we went to Congress, and why I'm proud that Republicans and Democrats came together to do the right thing.
Let me ask you to address what would have happened. I have talked to free market Republicans, Ted Cruz, for example, in the campaign, who said it was the wrong thing to do, should have let the market work, let the market sort it out. What would have happened if that had been the case?
So we faced, even with this massive intervention in the US economy, we still had 10% unemployment nationally, more than double where we are right now. In the Great Depression, we had 25% unemployment. It is easy to imagine that we could have been in the Great Depression again, 25% unemployment, not just bank failures all around the country, other businesses failing all around the country, the auto companies failing, et cetera. It would have been a series of dominoes, and no telling how deep it would have gone. And so when you're facing that kind of a scenario, as distasteful as it is, the right thing to do is to step in to prevent that from happening.
Now, having taken that decision to intervene, how would you evaluate how well executed the intervention was?
We got the big things right in the intervention. We weren't perfect. We made lots of little mistakes. When I reflect on our own actions, the biggest criticism that I have for myself and for the Fed and for the Treasury was that we were always late. We hated the idea of intervening in markets. I was a member of a free market Republican administration. We hated the idea of intervening in markets. So we were dragged kicking and screaming, saying we don't want to intervene. If we're going to intervene, we're just going to intervene just enough. So every month, the crisis got worse and we were dragged. The crisis got worse and we were dragged. So we were always late, we were always behind, we were always coming up short until Lehman failed. And then we finally went to Congress to ask for the TARP authority to step in once and for all and try to stop the crisis. And so I think we got the big things right, but if we had known how severe the crisis ultimately would become, we could have been quicker, we could have been bolder up front.
One of the big sources of criticism of the response was the decision to let Lehman fail. And there's arguments over whether there was legal authority or not. Do you think that letting Lehman fail was critical to getting Congress to step up and pass TARP?
I do. This was not a plan. This was not some grand plan. But so I remember this vividly. Lehman failed on, I think it was Sunday, September 14th. 2 weeks later, we went to Congress. Actually, by September 28th, we went to Congress 4 days later asking for the TARP authority. As you may recall, the House voted it down the first time. Mm-hmm. Members of Congress that we were negotiating with said, our phones are ringing off the hook 99-1 saying, don't you dare vote for this. Don't you dare vote for this. That afternoon, the Dow Jones dropped 777 points. Then their phones started ringing the other direction. Literally, not 99-1, maybe 50-50. And then 2 days later, they voted for it, and they passed it, and that gave us the authority. I hate to say that Lehman had to fail to show Congress how serious the situation was, but I think it worked out that way.
The Obama administration took a lot of grief from liberals for not taking a decision to break up big banks as they implemented the bailout. Were those critics right?
Well, that's the question that we're asking today in our effort to address ending too big to fail. So in my view, in 2009 and 2010, the transformational solutions like breaking up the bank or turning them into utilities were taken off the table. People said they're too bold and the economy is too fragile today, so let's keep the big banks preserved in their current structure and let's put regulations around them. That's really what Dodd-Frank is. What I'm saying now is the time. The economy is a lot stronger than it was in 2009 or 2010. Now is the time to give those transformational solutions serious consideration. And we have to hurry because societies forget. And we will forget the lessons of how bad this crisis was if we don't move now. So that's what's motivating me and motivating us to give these transformational solutions serious consideration before we forget.
Now, let me just ask a question about where you're coming from, preface this way. Since you have been attracting attention for this initiative, I've gotten a number of messages from friends of mine, friends of yours, who may have served with you in the administration, who say, where the hell does Neel Kashkari get off thinking that he is in charge of how big banks should be from the Minneapolis Fed? Why is he doing this? What's your answer? Because you've heard from some of those people too.
I have. My answer is I view my job and our job at the Federal Reserve Bank of Minneapolis to identify risks and to speak up if we see them. And if that means people are going to be unhappy, then too bad. You know, my old boss, Hank Paulson, likes to joke, it's only a little bit of a joke, that 60% of Americans are against torture, but 90% were against the TARP. And I'm the guy who ran the TARP. Mm-hmm. So I am long since past the need to be loved. All right? So I feel like if we were not standing up and speaking our minds about risks that we see, we would not be doing our jobs. And if people don't like it, that's okay. That's fine. I sleep fine, not worrying if people are happy or unhappy with me. That doesn't matter. Let's call the risks. Let's inform the American people. They can make the ultimate call on whether or not we've done enough.
Did the experience of standing for public office, running for governor of California, did that play any role in how you approach the decision to push this issue to the forefront?
It didn't influence whether it was an issue I wanted to tackle, but it did influence the manner in which we're tackling it. So to me, we have to have a national conversation. If it's just a bunch of policy wonks sitting in a back room discussing with each other the merits, nothing's going to happen. You know, Fed presidents give speeches all the time. Give a speech, maybe somebody pays attention for a day, but the next day everyone's forgotten about it and moved on and nothing happens. What have we accomplished? So to me, the key was how do we catalyze a serious national conversation about this issue? So that's why I announced it in a pretty bold manner in February, intentionally wanting to trigger a national conversation. The reason that we're having public symposiums with public town halls to engage the public in an open and honest manner so that ultimately all of you can be as informed as possible so that you, through your elected representatives, can make the decision, have we done enough? Do you want us to do more? What are the options? And so, yes, I think my experience as a candidate has tailored how we're doing this to generate the national conversation, but it's not shaping whether or not we're doing this.
Now, if the Fed is going to undertake an initiative of this kind, an inquiry of this kind, why should it be the Minneapolis Fed?
Well, first of all, as Chari mentioned, the Minneapolis Fed and the econ department here have been working on these issues literally for decades. You know, one of my colleagues at the Federal Reserve Bank, Ron Feldman, and one of my predecessors, Gary Stern, literally wrote the book Too Big to Fail, not the Andrew Ross Sorkin version, the first one, in 2004. You know, lots of people claim that they saw the crisis coming. 99% of them who say
Did Ron get the movie option on his?
He did not get the movie option, unfortunately. But 99% of people who said they saw it coming did not see it coming. Well, you know what? Ron Feldman and Gary Stern did see it coming. They wrote the book in advance. And so there's a great body of expertise that we're tapping into. And again, I say this simply, if we're not going to stand up and call it like we see it, who's going to do it? I don't see a whole bunch of other banks, Federal Reserve banks or other policy bodies standing up and saying, hey, here's a risk and we're going to do something about it. So we're going to do it. And if people don't like it, they can debate us on the merits of our ideas.
And what indications have you gotten from your colleagues at the Fed, from Janet Yellen, the chair, about how receptive they will be to your conclusions once you reach them?
The reception that we've gotten from within the Fed has been mixed. So Chair Yellen has been terrific. She said she's more optimistic at some of the progress that's been made, but she shares the concern to end too big to fail, and this is a very reasonable topic for the Minneapolis Fed to be working on. And so that's great to have her support. Some other Fed presidents have called me and said, this is fantastic, how can I participate? Some others have said, hey, I disagree with you, we think we've done enough. And that's okay. You know, the reason, one thing that's unique about America is that we have a distributed central bank. Almost no other country has this, with 12 Federal Reserve banks around the country. 100 years ago, Congress created this system to promote a diversity of views so that it's not groupthink in Washington, D.C. And so I think that what we're doing is highlighting the strength of the Federal Reserve System because we're all bringing different ideas to the table.
Now, I have been in the middle of discussions on CNBC, my network, between Republicans who say, fault Obama, fault Dodd-Frank for not ending too big to fail, for interfering with banks in various ways, but still not stopping too big to fail. And on with Barney Frank, one of the co-authors, who says, what are you talking about? We did end too big to fail. There are death panels in our bill. Banks have living wills. They have agreed to that they will be broken up depending on whether they're judged to be systemically important. What's wrong with what Barney Frank is saying?
Unfortunately, these are all well-intentioned, but I look at them through the lens of would they have worked in 2008? If we had these tools that they have now, if we had them back in 2008, would they have meant that we would not need to bail out the banks? In my judgment, the answer is no. And so, Congress
And why is that?
So the key is this. There's a risk of contagion between banks. If one bank gets into trouble and the system is otherwise fine, maybe these new tools can work. But when you have multiple banks that are in trouble at the same time, one bank fails, it can bring down all these other banks, which can then bring down the whole economy.
So is the flaw in what Frank's saying not that there aren't death panels? There are, but there aren't death panels that would quarantine the risk and prevent the failure of other institutions.
That's part of it, absolutely. And no one has figured out how to address this issue of contagion, this connection between, it's almost like a disease getting spread by different people. So what do? Mad cow disease, unfortunately, you kill the whole herd because you can't tell which cow is sick, so they slaughter the whole herd. There's a little bit of that in these big banks. If you can't tell,
I think you need
which
to go
bank is sick.
Zika on the metaphor now.
Fair enough. But this is really complicated stuff. And just because Congress passes a law that declares this is over doesn't mean it's over. Congress could pass a law tomorrow that says, we declare cancer has been cured. Does that mean that cancer has been cured? No. So we actually need to look at it and say, hey, does this actually work? If it doesn't actually work, we need to look at new tools.
You worked in partnership to prevent that Great Depression with Ben Bernanke, Janet Yellen's predecessor. He was at your session this afternoon and said, important issue, don't know that we've arrived at the final solution, but the way we arrive at the final solution is to follow the path that has been established in Dodd-Frank and see if we tweak the dials the right way as we go along without asking Congress to pass a new law. What's your response to the chairman?
Well, first of all, I have enormous admiration and respect for Chairman Bernanke. He did wonderful service for the country, and I take his feedback seriously. Chris here at the department asked a very good question then. He said, it's taken 7.5 years from the crisis to make the progress that we've made. What are we waiting for? Do we just need another 7.5 years? And so I think we as a country have to ask, are we making progress fast enough? Most of the panelists today, not all, most of the panelists today said if Citibank were to get into trouble, they would need to be bailed out today. And Citibank was just judged to be the strongest of the biggest banks. And if the strongest of the biggest banks still needs to bail out today, what about the weakest of the biggest banks? Personally, I think we can do better, and we need to move faster.
Is the reason for that, by the way, on Citi, that they were one of the banks who were identified as having living wills that were not adequate? Because regulators recently said that process wasn't good enough.
Correct. Regulators said that most of the banks failed. They said that Citibank was not credible. Mm-hmm. They were not willing to go so far as to say they were credible, but they were not credible, believe it or not. And so Citi was the tallest or the strongest weakling, think of it that way. And if that's the best we can do, is that, boy, this not credible is the best we can do, I think we need to aim higher.
Do you think that the substance and tenor of the presidential campaign is helping your argument that we need to do more, or hurting it?
I think it's helping it. I think the fact is this is not a partisan issue. There are people on both sides of the aisle who think we need to go further. And I hope both presidential candidates, or all the presidential candidates on both sides of the aisle, will raise this issue and advocate for more action. And again, at the end of the day, the American people need to make the call, either through the presidential election or through their congressional and Senate elections. Your elected representatives ultimately will need to weigh in. Our job at the Fed is to do the analysis, to present you with options, and then ultimately count on the American people to make the call.
Now, one of the, this has been an issue, a flashpoint in the Democratic presidential campaign, because Bernie Sanders has said break up the banks and has said Neel Kashkari agrees with me, point for me. Hillary Clinton says no, we have a law and we don't, we need to follow the law. There's been some debate over whether or not a president already and a Fed already possesses the authority to do what's necessary to break up banks if a more aggressive approach is needed. Does it?
I think you would probably need new legislation. I think technically the regulators today have the power, but you would need all of the regulators to agree. And to get all of the regulators to agree to something so transformational, very hard. So that's why my judgment is ultimately this is something for Congress to weigh in on and say, if we're going to transform the banking sector, Congress needs to say, hey, it's time to transform the banking sector. It's very hard to count on 8 different regulators to all reach the courage and have the consensus to make that call.
And that's because it's so much easier to get Republicans and Democrats to agree in Congress to do something than it is to get regulators to do it?
It's ultimately their job. And it's so much easier for the regulators to have an out and say, you know what, we're going to do something incremental. And if we do something incremental, nobody's going to get too angry at us. And that's what I'm afraid of. We're going to be led down the path. The default path is incrementalism. That's the path that we're on. And I'm asking the question, is that the right path?
But in a serious vein, if you conclude that new legislation is required to take whichever of the options you ultimately arrive on, what reason is there to think that in the absence of a crisis or the immediate aftermath of a crisis, that you could get Congress to move, because Congress can't move on much of anything?
Well, I think in this issue it's possible because it is nonpartisan. There are people on both sides of the aisle, and if you had whoever the new president is, if the new president said, hey, this is important to me, I want to do something, and you have some Republicans and some Democrats in Congress saying, we agree with you, I think it's possible.
Let me broaden the discussion out a little bit to ask about other steps that you think might or might not be necessary to assist the economy. One of the things that has become active on the left in the Democratic Party, or an issue that's become active, is reviving Glass-Steagall, which was eliminated in a deregulatory move near the end of the Clinton administration. Does that make sense? Should that be done?
I'm open-minded about it. I don't feel like the repeal of Glass-Steagall by itself is what caused the financial crisis. But
Did it have anything to do with it?
I think so. I mean, the fact of the matter is it allowed firms to get bigger and more concentrated. Could the crisis have happened even with Glass-Steagall? Yes, the crisis still could have happened. So to me, that's not a solution by itself. But if Congress, in their ultimate resolution, said, hey, we want to restore this, I don't think I would be strongly opposed to it.
One of the things that Bernie Sanders says in his campaign is that if your kid gets pulled over for drunk driving, he'll have a blot on his record forever. And yet we had the financial crisis and nobody on Wall Street was prosecuted at all. When you look back, having worked on Wall Street and having observed it from the Treasury Department, should somebody have gone to jail?
I think so. I think the vast majority of people who work on Wall Street, and I have a lot of friends who still work there, are good people who care about their countries and care about their communities. But there are bad actors everywhere, and they need to be held accountable. And I heard an example recently where somebody in the food industry, I think it was the baby food industry, cut corners, and they're in jail now. Well, if they can be put in jail, why can't executives of financial firms that commit fraud and that break the law? Right now, our solution is the shareholders pay fines. Well, what kind of solution is that the shareholders pay fines instead of the executives? And so I don't know, again, this is another example. I don't know if we need new legislation to give prosecutors the tools they need to prosecute these folks. I don't know. I'm not a lawyer myself, but we need to do something.
Well, I'm glad you made that point, because asked Governor Kasich that question during an interview during the campaign, and he said, look, I'm not going to trash talk federal prosecutors. If they had a case that they thought they could make, I believe they would have brought it. Is that how you look at it, or do you think that there was a decision taken not to do that for reasons of politics or reasons of preventing further instability? Is it the law that was a problem, or the approach of prosecutors?
My best guess is it was the law. I think prosecutors are, by and large, pretty ambitious people. And if they can find a high-profile case that's going to get them on the news, they're going to pursue it. But they want to win. And prosecutors don't like to take cases and come up short and lose. And so, to me, maybe they need more tools to be able to prosecute some of these cases.
Is there anyone in the audience who thinks that someone should have gone to jail for actions during the financial crisis? A few. Is there any who think that what was done may have been mistaken or ill-advised or too risky, but was probably not criminal? Again, we have a lean in our audience. A couple of other steps that have come up in the presidential campaign. Minimum wage of $15 an hour. Good idea?
You know, minimum wage is one of those things that I think is a very local decision, where if you're starting in a place of high unemployment and you raise the minimum wage, it's very damaging to people who don't currently have jobs. So you're benefiting workers who already have a job because their wages go up, but it hurts workers who don't have jobs and are looking for jobs. So they're trade-offs. If you're in a location like the Twin Cities with 3% unemployment, very few people don't have jobs. The costs of that minimum wage increase are going to be much, much lower. And so to me, this does feel like a policy that's much better done at the state or local level than necessarily done federally at one time. So
requiring firms to give stock awards or incentive pay depending on the profitability of the country in the same way that executives get bonuses in that way.
You know, I think that should be up to the firm. You know, if you look at, for example, our healthcare policy today, how people get paid healthcare, a lot of it was driven by wage controls way back coming out of World War II. Very good intentions has led to different distortions in our economy today. I think generally the government should get out of the business of telling firms the method in which they compensate their employees. Let employers and employees determine that.
Okay, two more, and then we'll go to questions from the crowd. Hillary Clinton has got a plan to adjust capital gains taxation so that you only get the lowest rate if you hold the asset for a much longer period of time, 5 years, I believe. Is that a good idea? She says it will deter short-termism among companies.
I need to think about it. My gut reaction is it doesn't sound like a terrible idea. I mean, I think things that can make us more long-term focused are generally better, but I don't know the details of how that plan is designed to see what else it may interact with.
Okay, last one. What about a large cut in personal income tax rates in order to spur economic growth? Would the growth be worth the added debt and deficits?
Well, I think, again, I hate to say this, I sound like an economist. It depends on the details. I learned this very quickly from the staff at the Minneapolis Fed. It depends. The bottom line is, if there are a lot of pro-growth economic policies we could adopt as a country, whether it's pro-growth tax policy, regulatory reform, these things would be good to get the economy moving again. The Fed is doing whatever we can. Like I don't want to say we're out of tools, but we're using our tools aggressively to get the economy moving again. What's left is not monetary policy. What's left is fiscal policy. Smart pro-growth fiscal policies could really make a big difference, and tax policy is one of them.
I lied, one more. What about a very large, taking advantage of low interest rates, a very large increase in spending on infrastructure and education?
I think if you have to spend on something, those are pretty good things to spend on. I mean, to me, investing in our workforce is number one in terms of our long-term economic competitiveness. And so that, to me, is top of my list. And if we invest in infrastructure projects that our country needs, probably going to have a positive return as well.
Okay. We have a roving microphone. If you have a question, raise your hand, and we will get a microphone to you. We've got a questioner right here in the front. Can we get a microphone?
I have a pure interest rate question for you. If you didn't intervene in 2008 and you think that free markets sort of kept going on, like you said, the domino effect, where do you think interest rates would be today? And secondly, do you believe that negative interest rates in 5 or 6 countries is a healthy thing?
Well, if you look all around the world, interest rates have been falling for decades all around the world, and real interest rates have been falling all around the world. I'm not sure that the interest rate environment would be very different today, because we're almost at the zero lower bound today, and if we'd had a terrible and even worse financial collapse in 2008, my guess is we'd be around the zero lower bound still today. So I don't think that interest rates may be in a different place. But what's interesting is that what's happening all around the world with these interest rates falling, this is not the result of central bank policy. This is the result of broader macroeconomic forces, demographic trends, the aging of society, technological trends, fiscal policies, excess savings around the world. This is ultimately what's driving interest rates in the US and Europe and Asia all to fall. Because central banks can only affect interest rates in the short term around the margin. Long-term interest rates are set by broader macroeconomic fundamentals. And so whether it's a healthy thing or not, I think we would all rather be in a macroeconomic environment of high growth, which would then justify higher interest rates. Given we are where we are, I think central banks are taking the action that whatever they can to get their economies moving again.
Okay, right over there.
Should the Federal Reserve be held accountable for missing this bubble in the economy in 2008? And if so, what steps are being taken to improve the analysis that the Federal Reserve does to detect these anomalies?
Yeah, it's really hard, I'll tell you. So the Federal Reserve is working very hard as a whole group of really smart PhDs looking at economic risks all around the country and around the world to try to spot the next one. So our eyes have been wide open since 2008. And I don't know a single person who predicted oil going from 150 to 30. That's a heck of a macroeconomic shock. And we totally missed it. And I bet everybody in this room missed it. And so
Didn't Nate Silver predict that?
I don't know. The hard thing is that it's very hard to know. Societies are prone to mass delusion. And it's very hard to know when everybody else is wrong and you're the one right one. And so I wish I could tell you that we're going to do better and we're going to spot the next bubble before it becomes too big of a bubble. But I think we need to assume we're not going to spot it, even though we're going to try, and instead make sure our financial system is resilient enough to withstand that correction. So the oil price went from 150 to 30, and it didn't devastate the whole US economy. That's a good thing. Well, we need to allow the banking sector to have big swings like that without bringing down the whole economy. Just like the tech bubble. It shot up in the 90s, it crashed, big bubble, we all missed it, and it didn't bring down the whole economy. So what I'm saying is let's have a financial system that's that resilient so we don't have to count on regulators being omniscient, because my guess is they're not going to be omniscient next time.
Now, I will say the guy in The Big Short knew.
Yeah, so here's the thing. With the benefit of hindsight, Michael Lewis cherry-picked 4 guys who happened to have been right this time. It would have been much more impressive if Michael Lewis had written that book before the crisis.
I think that's a very good point. Got one over there?
2 questions from an industry perspective. In your opening comments, you mentioned one approach would be increasing capital requirements for banks. Understanding that you're still exploring the options, would you be in favor today of increasing the risk-sensitive internal gradings-based approach, or something less risk-sensitive like Basel I, or at the margins, the Brown-Vitter bill with 15% capital? Second question, what do you see at this point in time as a boundary of too big, particularly with respect to asset size?
There are regulations that try to assess how risky different assets are, and then they force banks that have riskier assets to hold more capital behind them because they're riskier. Well, today, Greek sovereign debt is still considered risk-free, right? And so this notion of counting on regulators to be omniscient, to know in advance which securities are risky and which ones aren't, I think ultimately is pretty flawed. So as a general rule, I'm in favor of whether it's capital requirements or leverage ratios that have less complexity and count on less wisdom from regulators. Keep it simple, stupid, I think is a pretty good approach to these things. To the first part of your question. Remind me the second part of your question?
How big is too big?
How big is too big? This is another tough one. So we had Simon Johnson, professor from MIT, at the Minneapolis Fed for our first symposium. His recommendation was a bank cutoff should be around, I think he said $250 billion, 2% of GDP, 2.5% of GDP, or $250 billion. You know, I can't tell you why that's the right number, but I'll tell you this, I can't tell you why 65 miles an hour is the right speed limit either. And someone can say, well, if you can't tell me why not 63 or 66, then don't have a speed limit. I don't find that satisfactory. So, you know what? We may end up having to pick an equity, a capital ratio, or a leverage ratio, or a bank size, and it may not be perfect, but 65 miles an hour isn't perfect either. But nonetheless, we still need a speed limit.
You talked about as one of your options a tax on leverage. Question from our correspondent is, where would the funds raised from leverage tax fee go? Into a bank rescue fund somewhere else?
Well, that's ultimately would be up to Congress. So the whole idea of a tax on leverage is if you make the banks really safe, there's a risk that the activity leaves the banks and goes to hedge funds and insurance companies and shadow banks. And if they still do the same risky activity, have you made the system any safer? So an alternative approach is if you tax debt in the financial system, then you can follow that risk wherever it goes, whether it's a hedge fund or an insurance company or a bank. Now, ultimately, Congress would decide, because Congress decides where money gets spent. And so whether Congress wanted to use this revenue, I don't know how much it would raise, to lower other taxes, that's one option. That might be a pro-growth option. You lower more distortionary taxes. Or maybe you use it to fund future bailouts, or you use it to fund education or infrastructure. Ultimately, that would be Congress's call.
Who else?
Thanks for being here. Following up on what you were just talking about, do you foresee any further limitation upon an ability of an originating lender to limit the amount of debt passed on to succeeding lenders, whether they're the debt outright or whether they're packaged into derivative financial instruments and sold in the marketplace? And a second question is, do you have any comments about restoring the faith in our ratings agencies, which has a long way to go, at least for me before they are even not credible?
Yeah. Well, let me just start with the second point there. My view on this whole thing is we have to assume the rating agencies are going to screw up. So go back in time, 2005. We all, you and I, participated in a nationwide delusion that home prices only go up. Because in American history, they had only gone up. And the rating agencies believed it, the regulators believed it, the homeowners believed it, the investors believed it. And when that fundamental belief was proven to be wrong, we were all wrong, and we got into the crisis. And so,
let me just stop you there, because that's an important point. Because there's some people who think that the ultimate cause of the terrible crash that we had was fraud. You're saying it was not fraud. You're saying that everyone participating in the system believed in this model that was fueling this risky behavior.
Yes, and there was fraud as well. So, it's like in a bubble, people are going to be even more excited to take advantage of it. But I don't believe that fraud was the root cause of the bubble and the root cause of the crash. I think that this nationwide delusion was. And hey, I bought a house in 2005. So let me tell you, I was part of the delusion. And so I can't absolve myself of responsibility.
When did you sell it?
I still have it. I still have it. But, so we can't count on the rating agencies and we can't count on the regulators to be wise. Unfortunately, we can't legislate wisdom, right? Wisdom comes and wisdom goes. Let's assume we're going to be fools. How can we have a system that is still resilient even if we are all fools? In terms of the first piece, I don't know how much we want to regulate bank-specific activity. What I want to do is make sure that they are safe and sound enough so that even if they make mistakes, they don't bring everybody else down with them.
Okay, got one here.
Are there things that very big banks do positively or can do better than the next tier of banks?
Yes, actually, so in our symposium today, we had a portfolio manager from Franklin Templeton. He's one of the biggest bond managers in the world there today. And one of the things he was talking about is he invests in emerging market bonds. So you might be a pensioner and he's managing your savings for your retirement. He wants to be able to invest in the Ukraine and in Malaysia and in Bangladesh and in Argentina, all from the same portfolio. He can only go to big global banks to be able to execute those trades for him. Because if he just goes to a little local bank in Argentina and a little local bank in Malaysia, he's too worried that he may not get, the money may be stolen. So he wants to deal with big global banks who he knows and trusts, but they have to be sophisticated enough to have operations in all of those markets around the world. That's an example of something that big banks can do that mid-size and small banks simply can't do. And so somehow we need to figure out a solution that enables him to invest for you, but make sure that the system is still safe and sound.
Follow-up question to his inquiry. Chairman Bernanke, in his remarks this afternoon, said, we don't know for sure, but we believe that there may be advantages to scale that accrue to larger banks, and that if we broke up banks to some degree that we don't know how to measure, there may be fewer services at higher cost, which is less efficient for the economy. How seriously do you take that admonition?
Well, we do take that very seriously. This is about costs and benefits. So give an example. When you go through TSA security at the airport, you know that there's some risk when you fly. Right? There's a risk of a terrorist attack. It may be an extremely low risk, but it's not zero. And we as a society have decided how much safety we're willing to pay for. The safety we're paying for is the inconvenience of going through TSA. Like we could make it more safer by having somebody hand search your bag. Right? That would be more effective than an X-ray machine. But instead of 20 minutes, maybe it takes you an hour or two to get through security. And maybe your flight costs a lot more. So there are trade-offs in all of this.
We've just settled for the naked pictures of
Exactly. So there are trade-offs, and we have to assess, do we have those risks and those consequences right? Safety versus cost and versus convenience.
It is pretty well accepted, I think, that the success of the U.S. economy is substantially related to the success of small businesses. And small businesses are substantially dependent upon the well-being of community banks. The TARP funds allocated were given out basically 100% to the top 20% banks. Under that, the community banks got probably an average of about 6% of what was allocated. You had asked the FDIC to ask community banks who wanted and needed TARP to withdraw their applications. In retrospect, was that a mistake?
That's actually incorrect, sir. The TARP program for the banks, we allocated the exact same percentage of assets to every bank in America.
30% of risk-weighted assets.
Whether it was large or small. Every bank got the same pro rata share. They had to apply through their regulator. The regulator had to make a recommendation to Treasury because we only wanted to invest taxpayer money in what we considered to be sound, viable, healthy banks. And we started out, I will say this, we did start out with the biggest banks first because we were trying to get as much capital into the financial system as quickly as possible. And as you recall back in 08 and 09, the political winds shifted. It went from TARP, what is that, to TARP became a scarlet letter, right? Nobody wanted the TARP. And so by the end, after 6 months, a lot of banks were withdrawing their applications because they didn't want TARP money because they were getting criticized by their competitors. Like there were billboards taken saying, hey, John's bank took TARP money, ours didn't. His bank is bad, mine is good. And so a lot of small banks ended up opting out of that. But every bank was able to apply for the exact same terms, exact same amount of capital relative to their size, but they needed their regulators to give them a blessing before we would consider investing in them.
Related question that's come in through Twitter about small business. The question is, Fed policy is fixated on asset prices. Why don't you do more to spur small business hiring with tax incentives?
Well, that would be pure fiscal policy. And so the Federal Reserve simply has no legal authority to do that. It's uniquely up to Congress to be able to do that. All we can do at the Federal Reserve is manage interest rates. short-term rates, medium-term rates, expectations about where rates are going to try to incentivize borrowing and lending and economic activity. But that's literally, those are the tools that we have as a central bank.
And there's no way to tweak the dials on asset purchases and the other tools that you have to have a greater focus on small business?
Not, unfortunately, no. It's just an exceptionally blunt instrument, and we can't target it regionally. We can't target it to different demographic groups. We can only do it for the macroeconomy as a whole.
So 2008 was not just a U.S. banking crisis. It really was a global financial crisis. Are you having these conversations outside of the U.S., and does it make sense, or is it even possible to pursue this type of policy change without engaging the rest of the world?
You know, unfortunately, the rest of the world honestly doesn't care as much about too big to fail as we do. It really feels like other countries like having national champion banks, and that they're going to put their country and their taxpayers' money behind those banks. And so I feel like this is a situation where it'd be great to coordinate this globally and all move at once, but that's probably not very likely. We have a better shot of leading as a nation, show people this can be done, you can have a strong economy and a resilient banking sector, and then encourage other countries to follow along.
Do you support the Financial Services Conflict of Interest Act, which in essence bars former legislators and politicians from financially gaining from becoming a lobbyist?
Well, I haven't studied the act. You know, there a lot of people are. You know, I'm the poster child of the revolving door, right? So I worked at Goldman Sachs, then I worked at Treasury, then after Treasury I worked back in the financial sector, ran for office. Now I'm at the Federal Reserve.
That is outrageous.
It is outrageous. And so, you know, there a lot of people say, well, if you work in government, you're banned from working in the financial sector again. Well, imagine saying to the Justice Department, if you work in the Justice Department, you're banned from working as a lawyer again. Who's going to join the Justice Department? The Justice Department is a department full of lawyers. So if you take a policy and you say, you work in the federal government in your field, you can never work in your field again. Who's going to enter the government to want to work in that field? Think about the journalists. A lot of journalists are professional journalists and then go work for a member of Congress or a senator or the White House or an executive branch in their public affairs department. Now imagine, John, if you go work for the next administration, you don't get to work in journalism ever again. Would you ever do that?
That would probably be true.
That's true. Well done. Well done. So I think a lot of these laws or these proposals are well-intentioned, but they don't actually work in practice because they end up putting a big disincentive on qualified, experienced people from working in their field on behalf of the American people.
This is more a question that is not completely related to this, but there's a lot of money throughout the world that comes from illegal trade, arms, and illegal drugs. What's the role of the banks with money laundering, and what are the role of the Fed with that in that respect?
So all of the banks there's anti-money laundering statutes, and they have policies that they have to know who their customers are and where they're getting their funds before they can bring them on and do business and transact for them. So the banks all have requirements to make sure that they're not facilitating illegal trade or money laundering and whatnot. And part of the Fed's job as we supervise banks is we're examining their policies and their procedures to make sure that they're doing this right. And if they're not, we hold them accountable. You know, we'll audit them, we'll look at their activities and sanction them if they're not doing it right to make sure that they improve. I don't want to promise that we always get it perfect, but this is something that we do take very seriously, and we try to make sure that the banks are following the rules and doing the right things.
Speaking of following the rules, I'm going to close with a lightning round here because we're almost out of time. The Consumer Finance Protection Bureau, which is housed in the Fed, has become a source of controversy politically. Is that a good thing or a bad thing, the Bureau?
I think it's good that we have a Bureau looking out for consumers. I think a lot of the questions are on the oversight of it, and I think it's very reasonable for Congress to ask, do they have the right oversight framework?
Number two, if we end too big to fail, would that make America great again?
I think ending too big to fail would be a great thing for America.
And then finally, central bankers are supposed to be old with gray hair. Why are you a central banker?
I care a great deal about public policy, and when I got the chance to join and lead the Minneapolis Fed, it was a wonderful chance to work with terrific people who love their country, who want to make a big difference in the lives of constituents in our district and also nationally. And so I think it's a great privilege to get to be involved and to work on these issues and hopefully do some good.
Well, will you join me in thanking Neel Kashkari? And I think he has some people to thank as well.
So first of all, let me thank John. Really appreciate it. You know, the first interview I did in my life, TV interview I did, was with Charlie Rose, which was a very good interview. The second interview I did was with John Harwood, which was also a very good interview. And so, John, I appreciate you coming all the way out here from New York to be with us, or Washington. Mm-hmm. So how about a round of applause for John? I want to thank Chari and the Heller-Hurwicz Institute for hosting us today. It's a great partnership that the Minneapolis Fed has had for a long time with the U, and I want to do everything I can to continue to invest in the relationship. And so I really appreciate you hosting this. Emily Jacobs and all of the staff here at the University of Minnesota, thank you for your work. The Econ Department for everything that you do, and all of you. You know, it's so important that we're having a serious, honest national conversation about these issues. And so at the end of the day, my commitment to you is we're going to do the analysis. We're going to present you with what we think is a good plan. And then it's up to you to decide, is it a good plan? Do we want to go further? And then at the end of the day, you, through your elected representatives, need to make the call. So we're going to do our part. Then you need to do your part. So thank you for being here tonight.